You're in the Business Insurance Zone with me, Steve Savant, national insurance columnist and financial color commentator. This week on The Biz, the Life Insurance Income Series, our tribute to Life Insurance Awareness Month. And on today's show, the tax impact of retirement income.
When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Well, welcome everyone to the Business Insurance Zone. I'm Steve Savant. We're broadcasting live to a nationwide audience of financial advisors right here in Fountain Hills, Arizona, home of America's largest fountain. With me, co-hosting not only today, but all this last 4 days, Eric Palmer. Eric, we've been talking about life insurance income plans, and today we're talking about taxes. And I mean, we're going to take the first segment, we're going to try to give a fair treatment on both sides of the fence. Again, we're using 401ks because they're so popular and they're in the news now, especially with the 408 disclosure and compliance issues.
Right.
So let's talk about this. One of the things that was the shocker, and I brought this up in Monday's show, is when you're contributing to a 401k, before you make your contribution, because I always love the tax deduction, right?
Right.
But I have to still pay my Social Security and Medicare first, and then make my contribution second.
Right.
See now, so that is the I don't mean to. I love my government, but that is a stealth tax.
It is.
You know.
It is, and you know, it's one of those things where a lot of times we're doing comparisons. In fact, we have these calculators you can get a hold of. We have a plan called the IFL plan. If you haven't seen it yet or you haven't participated in it, definitely go to our website and check it out. But we have these great calculators that we can do side-by-side comparisons of life insurance plans, and specifically index ULs, to traditional retirement plans such as 401ks. And two major issues that we attack are fees, which we've talked about already this week, and taxes. Because even if I have significantly better growth or potential growth in my traditional retirement plan, when you start talking about taxes, you start really pulling back the clouds there, and you see the truth about these plans. And the reason that we point out the 401k so much, especially when we're going to talk about taxes, is that in 1978, the 401ks were actually developed as executive tax shelters. They were meant for the ultra elite to put large sums of money in because it mathematically made sense. They were only adopted by companies once they realized that you could put mutual funds inside of them, and they were cheaper for businesses than offering pension plans. So they became very popular. But mathematically, they weren't necessarily designed as being your end-all solution for retirement. So when you get into the tax discussion specifically, we really start to see where 401ks fall short and other traditional retirement plans. So the tax issue is truly a big deal. And what you mentioned there at the beginning, the ability to, or the actual situation where you end up paying a little bit more in taxes, even though that you don't think you are, that's a big deal. And you mentioned deductions. A lot of times I have advisors come to me and say, well, Eric, my after-tax dollars, I'm not getting the deduction that I would be getting if I was contributing to a 401k. My question is, when your clients get that money at the after April comes around, maybe they got a little bit of cash back in their hand in their return because they have this deduction for what they were contributing to. What do they do with their money? I guarantee you 90+% of the time, they're not reinvesting it.
Oh, no.
They're spending it. It's vacation time, summer's coming up, maybe you want to pay the credit card down a little bit. So it's nice to have that deductibility of what you're contributing to those plans, but the reality is, when it comes to my actual retirement income, that deduction is not really doing much for me, and the majority of the time, the clients are not reinvesting the money.
You need to find out, and this is a show giveaway, you need to find out what your client's blended marginal tax bracket is. That's first. Then go ahead and make your calculation. I'm going to take my deduction, what did I save off my bracket, and then I'm going to say, oh, but I had to spend my Social Security and Medicare on top of that. I don't know if it's going to be a wash, but the difference is so marginal on most Americans. Not everybody, but on most middle-class Americans, a little upper middle class, it's so marginal that everything he's saying makes sense. Now, remember, we're not just talking about the taxes on the front end of 401k. Here's where it gets messy. Everybody thinks that when I get my 401k, everybody knows, yeah, I got to pay taxes on that. Everybody's cool on that. And I think everybody in America's got that down. I'm going to be paying full taxes. There is no basis. I'm getting it all, but I have to pay taxes on all of it. And especially at 70 and a half, I'm going to be forced, whether I want to or not, I'm going to have to take RMDs, required minimum distribution. The difference is, every time I bring this, and I cannot believe this is new to 90% of consumers, that your qualified 401k will be used as an income test for provisional income test for Social Security benefits, whether they get taxed or not. Now that's where it really gets awful. Because now I'm looking at not only having to pay my taxes on my 401k during retirement, but now I have to pay, that could actually come on my provisional income test
Right.
of my Social Security benefits to test whether my Social Security benefits are going to be taxed. And I'm going to say most of the time, it's going to have something to do with taxation on my Social Security.
Well, absolutely, and we say it every single show. We're not tax advisors ourselves. We're talking about a math equation here. Okay, so definitely always consult your tax professionals.
Oh, always.
We actually have tax professionals here at Brokers Alliance. Ken Davis is a CPA. He's available to talk to you if you have specific questions or you want to do an extra analysis. But remember, at the end of the day, everything we talk about is a math equation. And what we're trying to do is we're trying to accomplish the largest net spendable income at the end of the day. How much money can I actually take receipt of after tax, after all the moving parts are out of the way, and go and spend in retirement? So Social Security taxation is a big deal. You were mentioning, I think, what your number was for Social Security. If you were taxed even additional 15%, that could cost you thousands of dollars every single year. And if we're not thinking about that, then we're not respecting the fact that we're trying to accomplish the biggest net spendable income for our clients.
By the way, I want to just jump on his statement here. Net spendable income. It's not about gross return. I have to pay my taxes. I have to do my fees. I want to know what my net, what's my real spendable? What did I get in my hand to spend? That to me is going to be the new mantra of retirement planning. What is my net all in? What's my cash flow? What can I take and spend?
Right.
That to me is going to be huge. Now, remember, if you say, Steve, well, I never even heard of the provisional income test, that's one of our show giveaways today. So if you want to order it, just order it at thebiz at brokersalliance.com and I'll send it to you. When we think about all the things we're talking about now, I'm talking about the front end issue of Social Security and Medicare. I'm talking about the back end that it could affect, and it will more than likely affect your Social Security benefits and having that get taxed, which by the way, 20-something years ago, Congress said they'd never do. Oh, okay, that's changed.
Right.
So all those are all in, and we'll come right back after we're done with this idea. When we come back from the break, we'll address the non-qualified use of life insurance as an alternative retirement plan. And don't forget to enroll into iuluniversity.com for the best training, education, and sales support when it comes to life insurance for retirement income.
You're listening to the insurance industry's #1 resource for products, planning ideas, carrier information, and interviews you can use. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Everyone's looking forward to retirement, but how do you get there from here? You do it by paying yourself first every month and saving with Index Universal Life. And once you're there, how long is your retirement? With Index Universal Life, it can last a lifetime. How much can you keep? It lets you keep all of it. And what if you need it sooner than later? There's no penalty for early withdrawals, and you have the flexibility that you need. How to get started? Go out to www.iflplan.com and find out more and start looking forward for retirement. Well, welcome back to the Business Insurance Zone. I'm Steve Savant with Eric Palmer. And remember, you can order today's giveaways at thebiz at brokersalliance.com. And just a heads up, before moving forward with any of the ideas you hear on our show, always consult your tax advisor first, as well as your broker-dealer compliance officer. We're talking about non-qualified use of life insurance as an alternative retirement plan. Someday, I hope to not say alternative, I hope to say as an additional option, because everybody keeps using the word alternative because as if we're in some new wave thing out there. And you made a point a couple days ago that said we used to do life insurance as part of our conservative portfolio way back in the 1920s, and we kind of deserted that because of the 401k market.
Right.
But one of the things that we said off air that I want Eric to touch on right now is we always talk about deferral, right? It's not elimination, it's just pushing it off. But in the plan on a 401k, I'm going to get hammered sooner or later.
Right. Well, and there's two major things to consider when it comes to let's just say a traditional retirement plan. It could be an IRA, it could be a 401k. First and foremost, we've run these calculators every which way from Sunday. We look at all kinds of different age ranges and deferral options. No matter how you slice the bread, within 2 to 3 years, you're going to pay back in taxes. And I'm using a modest 25% tax bracket in most of my examples because I'm trying to just be as simple as possible for consumers and fair as possible.
Right.
The reality is we're going to be north of that, and I think everybody can agree they're going to be north of that. But let's just say 25%. You're going to pay back all those taxes in the first 2 to 3 years. And you're also going to have to withdraw more money out of the contract to have the same net spendable income that you would have out of, say, a life insurance contract. So you have two things working against you. First, all that deferral Even if you're in the most extravagant matched 401k program, you're going to pay all those taxes back within the first 2 to 3 years. Second, you're going to have to pull more money out to have the same net money at the end of the day to spend and to go buy groceries and buy a car and pay your mortgage. So because you have to take out more and you've already paid back all those taxes, your account is more vulnerable to the withdrawals and to running out. So we hear these commercials all the time. I think Charles Schwab is kind of notorious for this. They talk about, what's your number? Is it $1 million? Is it $2 million? What's your account value need to be? And really, the account value is a moot point. If I took an account value of $500,000 in life insurance and an account value of $1 million in a 401k plan, I could probably still get more income out of my life insurance plan because I'm not taking as much out, so it's not working against me. I can use loans that are going to allow my money to still participate with the 401k. It's out of the cycle. Once I take that money out, it's out. It's not earning interest. It's not working for me anymore. And I'm paying taxes. And even at 25%, again, like I said, the math works out nearly every time. You're paying all that deferral back in the first 2 to 3 years, and you're taking out more than you need to take out in the first place to be able to spend a dollar.
Yeah, it's net spendable income. What do I take when it's all said and done, and how long is it going to last? And on top of that, we're living in the greatest mortality revolution mankind has ever seen. There's no way we're going to be living into our 80s. The baby boomers, especially the females, are all going to see 90 if they're anything like preferred or preferred plus. So it's really important to start thinking long term.
Right.
I mean, you could be on Willard Scott's show where he's celebrating somebody turning 100.
Well, if we think about it, there's a 53, I think the statistic is 53% chance that a female is going to live to age 85. Let's assume that she retired at age 65. That's 20 years. Currently, the way the traditional 401k plan, let's take a 401k that had a 100% match up to 6%. So the individual was matched dollar for dollar up to 6% of the contribution. When I run the math on that, let's say she bought it at age 40, okay, or was contributing starting at age 40, so contributed to a 401k for 25 years. The 401k is probably going to run out by age 82 or age 81. And in some cases, depending on the rate, and I'm assuming a 7.5% rate of return in that 401k. So you have a greater than 50% chance of living to 85, and you have a 100% chance that 401k is going to probably run out about age 81, 82, maybe 83 if you got a really good rate of return. Is that acceptable?
No.
It's not to me, and it's not to the clients that I want to talk to.
We're looking at these timelines, and we've qualified these by using either the 2001 CSO or the 2008 Society of Actuaries VBT tables to prove our point. Now, when we talk about taxes, we're talking about, we've already said, life insurance, whether you're taking out withdrawals to basis or policy loans to gain, as long as the contract was TAMRA compliant and you kept the contract in force, you're not going to pay any ordinary income tax, and that income coming from via loans or withdrawals to basis will never be counted on your provisional income test for Social Security. So if you just took out your life insurance, waited for your RMDs till later on at 70, and you just took life insurance, your life insurance and Social Security should be tax-free for that period of time. But heads up, some, not all, but some municipal bonds that will automatically be on your provisional income test for Social Security income could also trigger the AMT. So when I'm trying to compare a life insurance contract to maybe a Roth or a muni bond, I just say, the moment the person says, well, I'm into municipal bonds, well, I appreciate the tax aversion that you have, but you're going to pay that. And on top of that, remember, all the income that we're talking about, because it's coming out either withdrawals to basis or policy loans to gain, as long as the contract's kept in force for the life of the client, or the insured, I should say, technically, we're not going to have any of those issues on AMT. We're not going to have any of those issues, even though we are, sometimes life insurance can be under the alternative minimum tax for a death benefit, but for this scenario, it's not true. So I just want to bring these out. These are huge income, net spendable income scenarios that we're talking about.
And you can find this stuff. I mean, if you go to irs.gov, it's IRS section 7702 and 72E guidelines, that are talking about those benefits that we get out of life insurance. If your client calls you to the table, say, let's get your CPA involved, I'll tell you where to find these regulations. They're there plain as day. And you continue to bring up a great point about that alternative minimum tax and the taxation of your Social Security. At the end of the day, it could add up to a couple $1,000s. And if you ask your client, what could a couple extra $1,000s a year do for you, especially today, probably quite a bit.
Yeah, I mean, I'm thinking I saw my one client, he's got AMT charges, he didn't even knew he had it, and then his Social Security got whacked because he was trying to do municipal bond portfolio income. That's what we're talking about. That's why we're bringing it up on the air. And remember, you can watch this show and all our shows by clicking the red on-demand video button right on our homepage at brokersalliance.com. Well, that's the Buzz on the Biz for today. Get in the zone, the business insurance zone.
The Biz is brought to you by Brokers Alliance, a national leader in insurance products, support services, and educational workshops. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.